Put this all in context. You're sitting on a trading desk this morning, you're trying to figure out exactly how you kind of sequence everything out and what the market reaction is going to be. Give us your thoughts.
Yeah, morning, Guy. I mean, the first thing to do is not obviously to overreact. It's an isolated incident. It's in response to a specific event. It's a very targeted strike. We've seen already that it's got, as you just described, as Rami just described, it's got quite bipartisan support within Washington. It's also seemed to be receiving support from world leaders, around the place. Athey, here in the UK, Prime Minister Theresa May has also offered support for those actions. So, as it stands at the moment, I don't think we should, extrapolate this too far into the future. I think we have to treat this for what it is at the moment, an isolated incident, and therefore the reaction from markets of a small flight to quality, but nothing too crazy.
Is the break at the bottom end of the recent range for Treasuries, 10 years, significant?
I don't think so, because it's very quickly been rejected. We've seen a quick spike down to 228 and we're already back at 232. I think that's partly because we do have payrolls this afternoon. I don't think people would want to run with that in advance of an event which could be market moving in the other direction. I think if we were to close below 230, that would make it very interesting on Monday morning.
Is there anything really that could push Treasury yields down much further? I mean, they're already pretty low. They're already pretty richly valued. Is there anything you see around the corner that could push yields lower?
Yes, unfortunately. I mean, my base case is that the Treasuries are still way too expensive. They don't really reflect the economic fundamentals or what the Fed is guiding us towards. But there are just, as always, there are always a few clouds on the horizon. As a bond guy, we're kind of paid to look for those. That's what we do. So China is tightening its policy. I think it's fair to say that this cyclical recovery we've seen maybe since the middle of last year has been at least helped, if not largely driven by what's been going on in China. And they just starting to take the sting out of the system on the monetary policy side. If we were to see the same happen on the fiscal side, that could well start to just take the sting out some of the global growth and reflation which is going on. And of course, matters in Europe have the potential to be risk-off events which could see another bid for Treasuries. But I have to say right here, right now, given the levels, given the valuations, it feels like the skew should still be towards higher yields.
Yeah, I was going to say, on the other hand, you're losing a pretty important buyer in the second half of the year, or at least to some extent you are. And are you still preparing for 2 to 3 rate hikes still in 2017, James? Yeah,
Matt, absolutely. I think that's the really interesting thing is that we saw the Fed minutes, and again, they talked about the balance sheet unwind, and every time we hear from a regional Fed president, they're talking about the balance sheet unwind, and we don't quite know how or when, but I think it's fair to say that's coming. I think it's fair to say the same is coming with the ECB, and the market's reaction was to see Treasury yields fall. Now, I sort of understand how and why, because equity markets have been one of the big beneficiaries of QE, and so they took the news or the sort of further information about a potential balance sheet unwind negatively, and that does tend to lead to a fall in yields. But that really doesn't make a great deal of sense to me if what we're saying is there's going to be less buying from central banks, ultimately no buying from central banks, and indeed, because of the way that those rollovers have been financed, it means more supply from the Treasury as well. So, yeah, for me, that's still the story. Yields need to move up to reflect what's going on in monetary policy and economic terms.
James.